So in the last class we were discussing settlement risk. Okay, so I gave you the example of Herstat Bank. Essentially, settlement risk is, remember this concept that it relates to the delivery of the assets. Okay, we already discussed a case where we discussed that this is falling under the subtopic of, here you see settlement risk. This is falling under the subtopic that essentially here, okay, you see all these different, these are not important at this stage until we come to study the individual instrument types such as futures, forwards, etc., which we will do in the subsequent courses, swaps. But the point to remember at this stage is only this. The reason we are looking at these kinds of value, so we have value cash, we have all these different types of instruments or contracts which are distinguished from each other by, one of the main ways of distinguishing them from each other is by reference to the distance between the settlement date and the transaction date. In case of transactions value cash or value today, there is no distance. They're falling on the same day. So this is one useful way to distinguish between these types of instruments. So you see, once again, I think we have to make this much smaller. One of the problems of Chrome is that if you downsize one window, one tab, all the tabs, but Firefox doesn't make that mistake. Firefox is better, but then Chrome has other advantages. It's faster. Okay, now everyone can see all the options, all the instruments, right? So one of the ways we distinguish between this is basically by looking at the transaction date versus settlement date. And in this, as part of this subtopic, we have the question of, so strictly speaking, there should be a column between, somebody pointed it out the other day, at the end of the previous class, that strictly speaking, there should be a column between cash and spot, and that column should be called TOM. TOM is for tomorrow. Okay, so if you go to a foreign exchange trading room and somebody says SBI calling for Tom dollars, okay, Tom dollars means he wants to buy or sell dollars, he wants to transact in dollars, but he wants to do it for value Tom. That's not a normal maturity for for foreign exchange transactions, because normally foreign exchange transactions are value spot. Most of the transactions are value spot. So if SBI is calling for Tom dollars means that they want to get a price for dollars, okay, which they want a two-way price. We'll see what that is later. But they want to get a price for value tomorrow. Okay. So the other thing, obviously, you have to remember is that the price for each of these types of instruments will differ because the settlement dates will differ. Okay. So because of the time value of money, okay, and also sometimes the yield on a particular asset, obviously, when you realize that money, okay, will make a difference to the pricing. Okay, so therefore the price always differs based on the actual settlement date. So that's why they are calling for Tom dollars, means they specifically have mentioned that we want it for value tomorrow, not value spot. Okay, so strictly speaking, there should be a column here for Tom between cash and spot, because cash is T plus 0, Tom is T plus 1, and spot is T plus 2. Okay, usually T plus 2. So, but I have not put that value Tom column there because Tom transactions are not very common. Okay, so that's why I just put in cash to distinguish it from spot, to give you the idea that there is something before spot as well. Okay, this is called anti-spot. So cash and Tom are referred to as anti-spot. Anti, you remember, this anti is not ANTI. This anti is, so we can write this here. These are called anti-spot. If you look at an Italian restaurant, I was going to write antipasta. So the appetizers are called antipasta, which is, anti is the Latin for before. Like that's why we have ex ante, ex post. Remember in lab you studied ex ante, ex post. So this anti is not ANTI, it's ANTE. Anti means before. So anti-spot, now why we don't, the reason we have anti-spot transactions. So these are called anti-spot sometimes because they are before cash, before spot. So spot is T plus 2 and cash and term are T plus 1 and T plus 0. So these are sometimes cash and term are referred to as anti-spot. Okay, later on when we do foreign exchange swaps, you'll see that there's a separate subcategory of anti-spot swaps. Okay, where there's one leg which involves a cash or a term. So that's a term to be aware of, but I haven't put it because these are not common transactions. Okay, so under this we had, so the entire discussion here, you can see all this stuff of course, but the point is essentially this, that when you look at a futures quote list, this is actually net on your forwards, this is oil futures, So at this stage, we're not going to get very, you may feel that at this stage, you don't really understand, like I think Pulkit was asking about, I don't know what futures are, I don't know what forwards are. That's okay, you're not expected to know what futures and forwards because we haven't discussed those instruments in detail. You just need to know that, okay, these are a type of instrument, okay, these are not an asset class, these are a type of instrument, and they can be matched with any asset class and any market. And then you should also remember what we discussed earlier, that whenever you see a price for anything, in any market, this will take a little time to load. Yeah, let's give it time to load. Right here you can see they're giving it still spots. Okay, now if I go for, these are actually now quoting on a spot basis. These are spot foreign exchange prices which you've already seen before when I loaded the Ovanda FX trade platform. These prices are quoting on a spot basis, okay, and then if you wanted to see US dollar forwards against most of the currencies, you would click on this tab, okay, and you can see forwards. Now you won't understand this at this stage, but the point here to understand is that forward prices are quoted for various maturities. So here you can see 1 week, 1 month, 3 months, 6 months, 1 year. So these are various maturities forwards, and you have different prices for different maturities. Like I said, whenever you trade, the maturity here means the same as the settlement date. Okay, maturity is the same as the settlement date. So every time you change the settlement date, the price will change. As you can see here, the same market. If you freeze the market, you freeze the row and freeze the market. Okay, but you look at the euro, the price for 1 week and 1 month, 3 months, they're all different. Okay, that makes sense because of the time value of money. Whenever if you want to buy something and you get you are going to pay up earlier, it's just like if you want to buy something on EMI or you want to buy by credit card, because the retailer will get the money later, he will charge you a little extra. But if you pay cash, you get a discount because cash is going straight into his pocket right now. Okay. So I have to give it a little time to load. So there's a lot of material here. Main thing you have to understand is in this particular piece of software, once you guys are able to log in successfully, this particular piece of software is actually one of the best trading software that I've ever seen, best pieces of trading software I've ever seen in my 23 years in the industry. And so it's got tremendous capabilities. You can explore it on your own. There's no damage you can do. The only thing you have to be careful is you have 3 accounts. Your project trading account should be kept untouched until you actually start trading in your project, the real life trading, the actual trading for your project. Right now we're in practice mode. So with your 2 practice accounts, you can do whatever you want. There's no damage you can do here. Okay, so you can just click this, click that, just experiment. Okay, and try to figure out and try to learn about the capabilities of the software. There's a lot of stuff you can do here. So here you have, now some of the capabilities may not be available with respect to the NSE stocks, because this is actually right now the login that you have is only for the NSE. So some of the analytical capabilities may not be available for NSE stocks because there seems to be a different treatment of NSE stocks. You have a different login, like later on when you do your US equity option trading project, you will have a different login. This login will not work for that. Okay. Okay, so you might encounter that problem that some of the capabilities don't work, but you can always explore it first and see whether it actually works. So this is an example of what I mean by this, missing the chatter of open bid trading, that if you're missing the sound of all your bids and offers being shouted out, you can try this out. You have an ETF benchmarker, all this stuff you can try out. Okay, there's a lot of other stuff here. You can check this. I'm not interested in this right now. Okay, so what do I have here? 1,000 shares of TCS. This is the same login from which I did the recording for you guys. Okay, so the way you test that, just to test that if you have this, I just add one more stock, Maruti. Okay, and let's say I add, make sure you don't click futures or options, show you are trading in stocks. Here the stock means the cash market equities. These are not cash markets, these are derivative markets. And I think I might have clicked something else by mistake. Yeah, I must have clicked that. I clicked the futures. I clicked the options by mistake. So I go to stock here. So remember what I told you guys about cash markets and derivative markets. We're just showing you that in an earlier session we have discussed it. Okay, so that's why you have to be very careful. Finance is not a physics kind of subject where everything means the same. Once you use a term, it means the same in every context. But here it's a very context-specific subject. Okay, so cash in one sense is cash market. In the video itself, you've seen that cash is when we talk about cash markets here, we're talking about cash markets in contradistinction to. I'm going to select it first. Let's get the Maruti prices in. Okay, this also I'm going to. You can also learn a lot from here. All kinds of analyst activity. What is this? So for you, and you have news here. You can learn about our earnings calendar, all this stuff. I'm going to shut it down because I don't need all this stuff. Okay, this is that chart that I had loaded up for TCS. That is also showing here. Right. So I'm just going to quickly show you what you're going to do once you get a successful login. Okay. And since Surbi has been able to log in, I'm hoping that all you guys, if you use the right login, the right password, you should be able to log in. So I'm just going to try and quickly do a trade. So I want to do a market trade. I want to just test it. Okay. This is what I do. I do this and I just transmit. And I get this kind of message, but I don't get any kind of message. Notice that here it doesn't say anything about. You get the total value of the trade. Okay. You get all this margin estimates and all that. But you don't get any message here saying that your data is not live. Please don't trade in markets. Be aware that you're trading in a market without live data. There's a risk involved in that. You're not getting that. So I'm not going into the elaborate testing against Google Finance or against Yahoo Finance to see whether the feed is live, which is being shown in the video. Okay. Ideally, you should do that also once to get your own feel of things. But by and large, it looks to me like the feed should be live because otherwise it would have given me an error message. So I just quickly transmit. Down to the sound because my okay, so you see how long it takes. How long it takes to fill. Just to buy 100 shares of Maruti, they have to do 3-4 transactions. Okay, this gives you an index of how illiquid the market is relative to, say, the US markets. If you wanted to do a transaction of this value in the US markets, it would be filled instantly because it's much deeper, much more liquid. If you see here, I've shown you guys here this thing. Now you see, but this this is the average price. Okay, you can see the commissions you paid here. You can even compare this. Some of you have accounts in SMC and all that. You can compare this to your SMC commission and let me know how this compares. Okay, and this is the real commission. Okay, so everything in this platform is real except for the money. And so the commission that you get when you trade a real life account with IB, you won't get different commissions. You'll get the same commissions in India. Okay. So here you can see the breakdown of this trade. You can see how many trades had to be done to complete your 100 share trade. Okay. These are all the, and this you see is your weighted average price, and this gives you an idea of the execution. Should I click this? Yeah, this is just trades. Okay. All right. So this gives me an idea that this is okay. At least this is live. All right. So let's see where we are. So we are actually making money on our TCS trade. I don't know where we bought it exactly, but the market is a little higher. So okay. So let's go back to. I hope you're following where we were. Okay. We were discussing this. Okay. Now, so as I said, at this point of time, we started with settlement risk. We are going a little bit backwards. This whole business of, so the whole topic that is being discussed is this concept of transaction dates and settlement dates, and that these two are need not be the same. Okay. And depending on how depending on the distance, you have different types of instruments which differ on, at least on this point. Okay. So at this point, you don't have to get a very detailed look at futures, very detailed understanding of futures or forwards or swaps. Okay. You just have to know that, okay, there are different types of instruments with these kinds of names. That's all you need to know at this stage, because we haven't gone into the detail of these transactions yet. Is that clear? Okay, so to some extent, in many areas, you might feel that I don't know what, Aurora came with a question saying, I don't know why you bought, how did you decide to buy TCS, not sell it? Okay, so that question actually has a very long answer. Okay, so we are not going into that at this point. You can essentially assume that I just tossed a coin and decided to buy. But the more important thing is how I executed the buy order and how I set the stop. The stop should be clear to you. Okay, so just try and follow what is being discussed in the class at the current moment. And if there's anything that you don't understand, this will also put a lot of pressure on you guys to be more attentive and ask questions like Yash was asking the other day. Please explain it once again. You can always do that. Okay, so this will make everybody more engaged. Okay, so that you have any doubt at any point of time, you be aware of what is being discussed, and as soon as you don't understand something, immediately you should ask a question. Okay, is that clear? Okay, so So these are just broad, like you look at the, hopefully it's clear. So when you look at futures prices, this is what it looks like. So you see all these different maturities. I don't know if you can read on the last bench. Kanika, can you read? You can't read the stuff on the last, okay. So anyway, if you see it here, you will see that, yeah. So these are crude oil futures prices. Now you can read all this stuff. You can see that they are quoted for different maturities, and you can see that the prices in general different. You look at the last column, which is actually the second column here, the last price column. You see that the price is generally different from each maturity. So at this point, all you need to know is that futures contracts are quoted like this for multiple maturities. Okay, and you can see the URL here. So you can and that price is generally different for every maturity because essentially of time value of money. Okay, because the other guy, when you buy it, the seller's not going to realize his money. If the settlement date is further out, he will take a long time to realize his money. Okay, so there are some exceptions to that rule, but in general, that time value of money is a big factor in the pricing of any kind of instrument relative to its settlement date. So this is what you need to understand at this point of time, that you have different types of instruments called futures, forwards, and they all have different maturities, and the price will differ for each maturity. Okay, all right. So here we have then we have the discussion about settlement risk. So we've just gone back a little bit. So I had this little red marker for. We'll come back to this. Okay, and then we are looking at this. So the other thing to understand is that this I've already mentioned before. but we can look at it once again. Okay, that is that whenever you're looking at a price, any kind of market price, it's always going to be the price of some instrument or the other. Like I showed you futures prices, I showed you forward prices. So you can't, so price is something which cannot be seen. A market price is always specific to some instrument or the other. Okay, it's always going to be either a spot price or a futures price or a price value cash or a price value term. You can't have a concept of a market price which is disconnected from the type of instrument for which that price is quoted. Are you getting my point? It is always going to be shown for some type of. So whenever you see a market price, so someone tells you that the market price of IBM is whatever dollars, okay? Then the first thing you have to ask him is what kind of instrument are you talking about? Are you talking about the spot price of IBM common shares? Are you talking about the options on IBM? Are you talking about futures prices? What price are you talking about? What kind of instrument? So you have to basically go through this entire list of instruments, and you should have term also in your list in between cash and spot. So you should go through all these instruments and ask him, which of these instruments are you talking about? When you mention this price, which instrument does it pertain to? This is clear? Otherwise the statement is not really complete. Okay? Alright. So this is what we mean at this stage. So we have asset classes. So asset classes, let's just look at, I think by this time you're already quite familiar with all this. Okay, you have right. So here you see based on the asset classes, is everyone familiar with the concept of asset class by now? An asset class is just basically, we have a grouping of markets which are similar, okay? A grouping of similar markets. Essentially, so we say that these things like, say you have the Euro USD here, the Sterling USD here, okay? These are something, which asset class should we put them in? We have the following asset classes. We should put them in currencies. Okay, when you see Euro, USD, etc. Okay. Then if I show you stuff like the prices that you have here, all these Apple, Amazon, Alibaba, Disney. Okay, these are all spot prices. Okay, this is all dead here because the market is closed right now. Okay, so and anyway you won't get live data in this login for this kind of instrument. Okay, so these are all spot prices for where if we take all these markets. Okay, where should we put them in terms of asset class? Equities. Is that clear? Okay, and then if we have other stuff like, if I try to put in other stuff like, let's say, okay, so if I put in this, so this is the NYMEX copper futures. Let me look at September. Okay, so you see September copper, okay, is basically $2.71 per pound. Okay, so where does this instrument go? This is obviously, these are copper futures. Okay, so this goes in commodities. Okay, and specifically because I was plotting the price of, remember, price is always the price of some instrument or the other. Okay, so it's either a spot instrument, like these equities that we looked at, these are all spot equities. These were all spot equities. So specifically, they would have gone into this box, intersection of spot and equities. All right. In this case, now I'm plotting copper futures. Okay. I can also plot one more if I plot West Texas Intermediate crude oil. Okay. Now you can see when you enter CL, you get a whole bunch of options. You have to be clear about, you're not interested in Colgate-Palmolive spot equities. You are interested in crude oil futures. Okay. And so you enter that, you get a whole bunch of options. We will choose once again September. So here I have copper and I have crude oil. Okay. So both of these will go in commodities. Is that clear? asset class wise, they'll both go in commodities. I shouldn't have prompted you, but you guys have already answered for copper, right? So this goes in commodities, okay? And specifically, both of these are futures prices, so they go into this particular box here at the intersection of futures and equities. Sorry, futures and commodities. Correct. Good. So, are you following? That when you get that kind of instrument, you can put it in this. So that is the utility of this kind of a framework, because it helps you to take any market price that you observe for any price of any instrument for any market. You can put it somewhere into this box. Is that clear? So that is the utility of this framework. Yeah. Give her the mic. Yeah. Is it working?
Hello?
Yeah.
So how do you know that it is a future price of commodity?
How would you know? Well, one of the ways you know is that when you enter it here, okay? See, when you enter it here, what did they actually see? If we try, let's try and enter something else where if I can try and remember any of the ticker. So let's just try if we have. No, they don't have the LME zinc futures. Let me see, the New York sugar trades in both London and New York, but so when I have to know the ticker. So this is something that comes from your contextual knowledge. So typically the way the logic works is, it's a good question because it's a fundamental question, okay? So first you have to know what you're looking for. So if you know that you're looking for sugar prices, okay? So you have to know that sugar trades, this is part of your contextual knowledge. As you research the sugar market, you will know that, okay, there are markets it'll either be a futures contract, or it'll be a forward contract, or it'll be an OTC market instrument. Forwards in an OTC instrument. So if you generally, there's a lot of activity in the futures exchanges. So as part of your contextual knowledge, okay, you need to know that futures trade, you need to know the names of the major futures exchanges. So in this case, you should know that the CME group is one of the major futures exchanges, and they trade a lot of these, agricultural commodities. Okay, so you will go to the CME group website. Okay, that is how it will work. You'll go to the CME group website, and you will find out from them the agricultural futures contracts that they have. Okay, and so the New York Board of Trade, this is NYBOT, is a So this is one of the major futures exchanges in the world. We go to their website and we would find out, if I'm interested in the sugar market, I would find out whether they have sugar futures, and you will find that they do have sugar futures. I have to make this much smaller. So here you can see agricultural products. You go into so this is a very useful website, and they have good information. So as I told you, don't go and navigate anywhere on the web for information, especially on technical subjects like finance, because there's a lot of garbage out there. People don't explain the concepts properly. So go to only certified websites, which I'm directing you to. So this is one of those websites. They have good information. There's a lot of material here. You can learn a lot from this website. So you can go to the CME Group website. You would go to trading. This is how we proceed with any major exchange. Okay. So if you want to go to the ICE is another exchange. ICE is Intercontinental Exchange. Now they just call themselves ICE. Okay. So if you go to agricultural product, if you go under product groups, you go to agricultural, and there you'll find they will list all the products that they have, and eventually I'm sure you'll find sugar there, because NYBOT is part of the CME group. Here. So you can see once again categories and subcategories. You can see how many, I don't know again if you can read this stuff or not. Grains and oil seeds, can you read? Okay. Okay, so under agricultural, you can see there are so many subcategories. Okay, grains and oilseeds, livestock. Okay, so cattle and all, you have futures contracts on cattle as well, on pigs and all that, on pork bellies. All that stuff is there. This is again showing you how, this is why I tell you guys to keep focusing on US markets and the US economy, because by looking at that, you get to see what a developed economy looks like. Here our regulators are so confused. Every time the prices of some agricultural commodity goes up, futures prices go up, they stop trading in the, in that particular in that complex. Okay, which is a totally stupid thing to do, because what you're doing is you're disincentivizing the guys who bought lower down. Okay, so when prices were falling, okay, so let's say jeera prices have gone up a lot, and then the government comes in and stops the trading. Okay, what happened here now? I have to cut marks for Ritesh and Shivam. What is happening? Okay, fine. I'll give you the benefit of the doubt because we want to see full engagement in the class. Okay, so what is happening here is that why is this a stupid policy move? Because what is happening is, suppose jeera prices were dropping a lot, or pepper prices, let's say, were dropping a lot. Okay, and it was hurting the people who were growing those products. Okay, people who grow pepper. Now I come in as a speculator and I decide these prices have dropped a lot. Now they seem like a very good bargain. Pepper prices will not fall much further. I come in and buy a whole chunk of pepper. Okay, so that supports the price, and then eventually it starts to go up. But what does the government do? Let's say I bought it when the prices were 15 rupees. Okay, and whatever be the unit, and then as soon as the price starts going up to 45, 60 rupees, then the government stops trading. So what has the government done? The government has capped my profit by buying the contracts at a lower price. When the price was dropping, I took some risk because prices could have dropped a lot further. Are you following the logic? So by coming in as a speculator, I actually benefited the economy in some way because I prevented a further fall in prices by taking an opposite position. But by doing that, I also took some risk. But if I take risk, I should also get a good return. So what the government is doing by doing these kind of stupid things, like suspending trading as soon as the prices go up beyond a certain point. So what the government is doing is now they're capping my profit. If it goes above 50 rupees, then they say it's too high now, we have to stop trading because there's speculative activity. So what have you done? You have capped my profit. So what will happen next time? Next time when the boy cries wolf, what will happen when the prices are falling? I will be a little more hesitant to go in because I know that as soon as it goes up a little bit, the government will cap my profit. So next time I'll wait a little bit longer. I'll let it drop a little more, right? Earlier I stepped in at 15 rupees. This time I'll let it go to 5 rupees. So what's happening then? The growers are getting hurt even more, right? So by interfering, I mean, you have to be a total moron to do these kind of things, but this is what happens in this country year in and year out. Okay, and this is why this country is not a first world country. Otherwise, if we had followed the right policies, there's no reason for us. We should have been an economy bigger than Japan by today. Okay, but because the only reason we are behind is we have followed absolutely idiotic policies, and we are continuing to do the same thing even now. We're not opening up the markets. We're not following free market policies. And everywhere in India, you'll notice you'll never find a single person in India who understands the value of speculation. Everywhere speculation in India is a dirty word, but actually speculation has a value. The speculator adds liquidity to the market. He provides the other side of the transaction. Imagine that if you have a pepper futures market and all the players are people who are growing pepper. Okay, so what's going to happen now, if you have an imbalance? Let's say there are growers of pepper also and there are buyers of pepper also. But there's a little imbalance because growers are more interested in selling and buyers are not so interested in buying. Here's where the speculator comes in and provides balance to the market, because speculators, you can assume, kind of will be 50-50. Some guys will be bullish, some will be bearish. Okay, so about half the guys will come in and they'll try to provide buying support because they are interested in buying, right? So that will help the growers because they'll get some price support. Are you following the logic? Okay, so we've gone into a policy discussion, okay, but it's important for you guys to understand this because in India nobody understands the value of speculation. Even guys who come with like PhDs from MIT, they sit as a chief economic advisor, and then they come and say that speculation is bad. You'll never hear an Indian policymaker saying the speculation is good. They just don't get it. Okay, which is why, as I said, this is why we are a backward country. This is why we are not realizing our potential. Otherwise, we should have been an economic superpower like 30 years ago. But anyway, so as you can see, coming back to Parul's question, Parul has lost interest because we are discussing policy matters. Now, coming back to your question, how would you know? This is how you would actually know. Okay, you would actually know what you're looking for. You would know where to find it. Okay, this is part of your contextual knowledge of markets. You go there and you find out. Okay, now you go to where will I find sugar in this, guys? Under what category? Grains and oilseeds. Sugar is going to be under what? Grains and oilseeds. Sugar is a grain and oilseed. I'll find it under dairy. Then sops. Sops is sugar, cocoa, coffee. Okay. Cotton is also there. They're not listing the cocoa here. I don't know why they've not listed the cocoa here. Maybe it's on a different. It should be here. Maybe they've discontinued it. I don't know why. Because cocoa trades in London as well. And as far as I knew, it was trading in New York as well, but they've stopped it. I guess whatever, we'll have to find out. So here you know. Now if you click on the sugar futures, okay, what will happen is we are deviating a bit from the basic structure, but it's a good question. How this tells you how to navigate markets, how to find out about markets. Okay, so all this stuff is learning for you guys. So this contract is called number 11 sugar. Okay, it's traded on the CME group, the New York Board of Trade Division. Here, when you go into contract specs, so actually, in a way, what the question that Parul was asking is, I think, how did I know to type SB? Why did I type SB? Why not, LM or whatever? Okay. So the way you find out, the way you know that is basically from here. They would have given the symbol somewhere here. Ticker symbol would have been mentioned under the contract specs. Where is the symbol here? Okay, so some reason they've not given the ticker symbol here. It should be available somewhere here. But anyway, so maybe that's an IB specific ticker, but anyway, so from here, if I know that I have used SB here actually, so I know when I type SB I get this option. Okay, so I get the sugar futures option, and then I've chosen futures, right? So that's how I know it's a futures price, because I asked for the futures price, and then it's giving me the futures price. It should give me a pop-up of, why is this pop-up not coming? So we're not going to waste more time on this, but essentially this is, for some reason, it might have frozen or something like that. I don't know why it's hanging on. I think it's hanging a little bit. Yeah, see, it has eventually come up. So when I choose futures, because remember futures trade for different maturities. You saw that display on the crude oil futures page. They trade for different maturities, and so the moment you choose futures, it was hanging actually. It's taking a little time. So you can see here, at the moment you choose futures, it'll ask you another question. Okay, which futures contract do you want me to show you? Okay, so then you can choose, and in this case we'll choose the April 20th. So now we know these are the sugar prices. Okay, right? So this is essentially how you know that this is a particular. You entered the trick basically, because the logic is that you know, because this is the ticker that you enter. You ask for the sugar price, and how would you know the ticker? You would know from this contract specs page. I'll tell you why it's not there. Maybe we see it in the quotes. They've shifted it to the quotes. The ticker symbol should normally be there. I don't know why they're not showing it here. realization. The ticker symbol should be there. So this is something that you would know from reading the exchange web page. They will tell you what the ticker symbol is. Just like this CL, I know that it's CL, the ticker symbol for. So this is a part of your contextual knowledge you'll figure out. Okay. All right. So we have deviated quite a bit, but hopefully it's still useful material. Okay. So we had just come here. So essentially now you understand what an asset class is. We were just discussing this. An asset class is just a grouping of markets that are similar. Okay, let's close this. This is just a grouping of markets which are similar, and so market we have already discussed. So the framework is called asset classes, markets and instruments. So asset class we have understood. Market is, we have already defined a market. A market is a venue for exchanging two assets. So whenever you hear the word market, so here I've tried to, in the body of material that I'm sharing with you guys, we are very consistent in the use of terms. Okay, so once I've defined a market as a venue for exchanging two assets, every time I use the word market, it always has the same meaning. Okay, so you have that advantage. Okay, of it's being used. Connection reestablished. Okay, so a market is a venue for exchanging two assets. Okay, so the moment you change any of the assets, it will change the market. Okay, so if you, for instance, go to we are not going to spend time on that right now, but if you change, so for instance, gold trades mainly in terms of US dollars, but you can also take a gold price in yen, or you can also take a gold price in Indian rupees. So all of these would be treated as different markets. So when you're talking about gold as in Indian rupees, that's a different market because the two assets are gold and Indian rupees. That's a different market from the gold market in US dollars because the two assets there are different. One of the assets is different. Are you following what I'm saying? So this is what it says here, that a value changing any of the assets changes the market. So in terms of our terminology, we will use this concept that the moment you change any of the assets, so if you have gold, if you have a connection lost, a connection reestablished. Okay, so the moment you have gold in US dollars, that's one market. But the moment you start quoting gold in Japanese yen, that's not the same market. We no longer say it's a gold market. It's actually what we should be saying is that it's a gold market in Japanese yen because the terms asset has changed. Are you following? Okay, so this is how you would treat it as a different market. Okay, an instrument is a contract. We have already discussed the various types of instrument. Okay, so it is always for the same. It's always the market price for some particular type of instrument. Okay. Okay, some other types of instruments which are not shown in the framework is value TOM and a CFD, which is a contract for difference. We are not going to go into this contract at this point, okay? But you should just be aware that there are some other types of instruments which are not very common, okay? And a CFD essentially is a retail instrument. In this particular set of finance electives, you are being trained for working in an institutional setting, okay, in a finance role. So therefore, I'm not emphasizing or teaching you an instrument called CFD. You should know that there is such an instrument, okay, CFD, which is contract for difference. We are not going to go into the operation of that. It's just like a OTC market futures contract. Okay, that's how essentially it works. Okay, but it's a retail instrument. Nobody in the institutional market uses CFDs unless they're trading with retail customers. Okay, so in an institutional to institutional, a B2B setting, you guys are basically being trained to operate in a B2B setting mainly. Okay, so in a B2B setting, nobody uses CFDs. Okay, they use futures contracts or forward contracts. So, but you should be aware that there are some other types of instruments like value TOM, contracts for difference, and non-deliverable forwards, NDFs. Okay, these are called NDFs. This is an institutional instrument, not very actively traded. It's mainly for currencies with capital controls like India, China. Okay, so you have a rupee NDF market in Singapore, non-deliverable forwards, very small portion of the overall market. So basically, if somebody tells you what are the types of instruments that you're aware of, you would show the 6 instruments in that framework. Plus, you would say that instruments that trade value TOM. Then you have a retail instrument called a CFD, and then you also have non-deliverable forwards. Okay, but these are not very mainstream instruments. These are not actively traded instruments. Okay, but you should be aware that these instruments exist. Okay, so in any market at this point, what we want to do is we want to identify the base asset, the terms asset, the unit of the base asset, like whether gold is being traded, price is being quoted as per 10 grams, or gold price is being quoted as per troy ounce. Okay, all right. So the unit is different from. We should write this here. The question that Sakshi Jain was asking the other day. Unit of base asset. I think you were asking, or somebody else. Or maybe I think it was Radhika who was asking this. Unit of base asset, okay, is different from. I'm not going to write perfect English here, so it will be the concept, but I'm just writing concept of market lot. You know what a market lot is? A market lot is in regular dealing, there is a certain lot size, okay? Like if you go to the Gazipur wholesale market for vegetables, maybe they are trading potatoes in terms of a quintal. So you can't go and ask them, give me a price for 1 kilo of potatoes, okay? So that means that the market lot there is 1 quintal, okay? So in every market setting, they will evolve their own conventions. This is a matter of convention. They will evolve their own convention as to what the market lot is, okay? So which means that normally when you quote a price, the price is quoted, if I give you a slightly different example, the price may be quoted per quintal, but the market lot might be 10 quintals, which means that whatever the price I'm quoting you per quintal, but this is understood as being valid for a multiples of 10 quintals amount. You can't trade that amount. You can't take that price and say I want to trade 3 quintals. Are you following? Yes, minimum. You have to buy in multiples of 10. Okay, so let's put it this way. Let's put it another way. Okay, say let's look at a real life example from here. Okay, now here you look at these prices of Facebook. Facebook had a big fine imposed on them recently. Okay, so now let's look at prices of Apple. Okay, now let's just take the bid side, 203.45. Now this is the price per common stock for 1 common share of Apple. That 203.45 is for 1 common share of Apple. But it is understood that when this price is being quoted to you, this is for a transaction for multiples of 100 shares. You can't expect to get this price if you want to trade in 37 shares. So in this case, the unit of base asset, because I've told you to distinguish between, I've told you whenever you look at any market, identify base asset, terms asset, unit of base asset, what instrument are we talking about, okay, and whether it's an OTC market or an exchange traded market, okay. Usually this comes from understanding the instrument, like futures are exchange traded instruments, forwards are OTC instruments, but some types of instruments are available in both settings, like options. You can have options on currencies. Let's say you can have them in the OTC market, and you can also have them in the exchange traded markets. So you have to also be clear about, are we talking about an OTC market or an exchange traded market? Okay, this is basically to get the full value of this framework. Remember this framework, it tells you all kinds of things. It tells you about asset classes, instruments, and in between you have all the markets, like I told you, spot currencies. Here you imagine all the possible currency combinations. Like you remember your NC2 formula, factorial n and all that permutation. So actually what you have to do is you find out like how many countries exist, and that's your end, let's say 156 or whatever. Okay, so that means here what you actually have in this, inside this cell, you have to imagine NC2 where n is equal to 156. So you have to imagine that all those, that many pairs are being shown inside this box here. Inside, I already went through this the previous day, remember? But I'm just rehashing it once again because it's an important concept to understand how this framework works. Asset classes, markets, and instruments. At the intersection of asset class and instrument, you have the markets. Okay, and inside this, you have to imagine. I'm just giving you the example for currencies, but for every other asset class instrument combination, the concept is the same. So technically, if you have 156 currencies, inside this box, what you have to visualize is there are 156, NC2, 150, where N is equal to 156. That many pairs are being shown inside this box. So Euro USD, comma, USD JPY, comma, USD CAD, comma, and so on and so forth. Are you following? Yes? Everybody follows what I'm saying here? Yes? Not convincing. The nodding is not convincing. Or are you just tired? Okay. Yes, Piyush, have you followed what I said? This is how you have to visualize it for every box. Yes.
Please let me know that whether the price is for 100. Like you said, if you buy Apple stock and the price is 2 rupees, so it has to be 100 shares. So how will you let me know whether it's for 100 shares or it's for...
No, this is something again part of your contextual knowledge. So as I said, in finance, like in pretty much any subject, you have two types of knowledge. You have contextual knowledge and you have conceptual, conceptual clarity. So here, you need to have both. So this is part of your trading US equities. If you're going to be trading US equities, this is something that you'll encounter in your research, that the market lot in US equities is 100 shares. Yeah, and the quoting convention is per share. So this is what I mean by saying that when you're studying any market, be clear about the unit of the base asset, which in this case, the example of common shares of Apple, the unit of the base asset is one common share. Okay, but that is different from the concept of market lot. Market lot is decided by convention. There's no conceptual element in this. But what is market lot? That is a concept. That is that it is understood that this price, this 203.45 price for you to sell, okay, is only available if you are dealing in multiples of 100 shares. If you want to sell 23 shares, you may not get this price. Okay, that's called an odd lot. Okay, so the opposite of market lot is odd lot. Okay, so we've explained market lot. We should also write opposite of market lot is odd lot. And odd lot pricing obviously will not be as attractive as market lot pricing. Is this clear? So, let's try and quickly cover. We have 10 minutes. We have plenty of time. We can cover now our next concept. Okay, players in financial markets. Okay, so we have covered essentially this part of this thing. We will now quickly try to cover players in financial markets. What types of players do we have? We have, essentially you can see three types of players. So we have three high-level categories and then we have a sub-categorization within speculators.
So the unit of base asset is actually a quoting convention. For example, it is one share in US markets.
Yes.
But in the market, you notice that it will only be dealt in multiples of 100 shares.
Yes. So that's why I said that in any market, when you're looking at any market, when you're studying any market, okay, when you're studying any market from the perspective of understanding the quoting conventions, understanding the context, okay, these are the things you have to be aware of. What is the base asset? What is the terms asset? What is the unit of the base asset? Like in India, we quote the gold price as per 10 grams.
The base asset would be gold, term asset would be US dollars. Unit of base asset would be for 10 grams or whatever it is.
Yeah. And then market again has to be thought of as a different concept. Now you clarify from the market concern what is the market lot. Like in India, the quoting convention, the unit of base asset for equities, if you look at Indian equities here, okay, where we have, I don't know where that went, here, okay. So here I traded in 100 shares, but I could have bought even one share. So in India, what is happening is that the unit of base asset for which the price is being quoted is one share, and the market lot is also one share. But you should still understand those two concepts as separate concepts, because this may not be the same in every market. Okay, like in the US market, you can see that the unit of base asset is one share, but the market lot is 100 shares. So you should understand both. So that's why when you're studying any market from a contextual familiarity point of view, you should identify these aspects. Okay. Right. So okay. So we have three types of players in financial markets: arbitrageurs, hedgers, and speculators. And you see how they are defined. They are essentially defined in a very simple way, by looking at this common element, okay, with respect to how they behave with respect to risk, what they are trying to do with respect to risk. Once you understand the concept, it will become very easy to understand. Okay, so maybe first we should, we can start with arbitrageurs. Okay, these guys are not willing to take any risk. Okay, and here when we are talking about risk, we are actually talking about market risk. Let me just clarify that. Maybe we should just collapse these a little bit. It'll make it easier to see them together. Okay. And we'll collapse this also. Just a little bit. Alright, and here. We'll put these as directional speculators and market makers. Alright, so we are going to say that this risk, the risk is referring to, you'll understand later, there are very many categories of risk. So what we are talking about when we are talking about risk here, risk so this little asterisk applies to all these three categories, okay? Same asterisk, alright? So when we are talking about risk here, we're only talking about market risk. There are many types of risk which we will study later, but for now all you need to understand is that there are many categories of risk, and there's one category of risk which is called market risk. Market risk is nothing essentially, it's the risk that arises from market price fluctuations. Like here you can see that 1,000 shares of TCS which I bought when making that video for you guys. On that it's showing a profit of 23,500. Now it could have also been a loss. Okay, so this is all the P&L that is happening because of the fluctuations in the market price of the asset. Okay, so I bought it and it happens to have gone up after that, so therefore it's showing a profit. If it had gone down, it would have shown a loss. This is what we mean by market risk, the risk that arises from fluctuations in the market price. Okay, there are other types of, one example of another type of risk is credit risk. Like we talked about Herstat risk, settlement risk. That's what we refer to as a type of credit risk, that the guy doesn't pay. It's the same example that I gave you. I go to a furniture shop, I order the furniture, the guy delivers, and then I tell his delivery guys, okay, you can go now, I'm not going to pay. Okay, so that's an example of credit risk. Then I took the stuff, but I didn't pay. Right? So that's just market. So we can understand these guys, the categories of players from this very simple idea. First, we'll go into the detail later, but first understand how it's organized neatly around this concept of risk. Arbitrageurs are looking to make riskless profit, which means they want to do transactions in which they are trying to make profits and they are not going to carry any market risk. Here, if you see I'm making profits, look at what I mean by this. Here, actually, I acted like a speculator. I went and bought 1,000 shares on Friday or whatever day it was. Okay, and now it could have gone against me. It's happened so far that it's going in my favor. Okay, so I'm making money, but I'm carrying some risk because it could have also gone against me. The arbitrager doesn't want to carry any of this risk. He wants to lock in riskless profit. Okay, we'll understand how this happens later, but first understand the concept of arbitrage is the guy who doesn't want to take any market risk. He wants to lock in a profit without taking any market risk. The hedger is someone who is looking to decrease their risk. Okay, so what we say, the definition of a hedger is this essentially. This is how you should understand. Don't memorize it, but in a way you can understand the concept from this. We'll study in more detail later. But the way to identify a hedger is an entity whose first transaction will always reduce their total risk. Okay. To some extent, this definition will only become clear when we go into risk management and hedging later on. But this is what we are talking about. And you look at the definition of speculator. So you can see hedger and speculator are totally different. Because in the case of a hedger, the first transaction decreases their total risk, and in the case of a speculator, the first transaction increases their total risk. At this point, don't worry about the total part so much, but basically just focus on the risk because we haven't discussed what are the components of the total risk. But this is how we are trying to define the three categories of players. That you have hedgers, speculators, and you have arbitragers, and they are defined with respect to what they want to do to their risk. Okay, so these guys are always trying to reduce their risk, and speculators are trying to increase their total risk. The first transaction at least will increase their risk, and the arbitragers don't want to take any risk at all. Okay, so we'll come at this point. We are just going to skip through this definition at this level itself, and try. Okay, so we are out of time. All right, so this is your stuff on the three types of players. So the next topic that we have moved on to is essentially this: three types of players in financial markets. Okay, arbitragers, hedgers, and speculators. Okay, and further we are dividing speculators into two types: directional speculators and market makers. So you have a high-level category, three high-level categories, and under speculators you have a further sub-classification. Speculators are being divided into market makers and directional speculators. This is clear? Okay. Anybody has any? Okay, your class is dismissed. So anybody who has any questions can ask me. Any technical questions? And I'm going to close the recording. No, class is dismissed. So those who want to go can go. But normally some people have technical questions. So if I'm answering a technical question, I will make sure that it's recorded. Sorry? No, he will have to put in 1 minute. If he wants to buy only 23 shares, if you want to sell only 23 shares of Apple, you will have to put in an order to sell 23 shares, and you don't really know exactly what price you're going to get. You cannot expect to get this market price. Even in the case of a market lock transaction, you can't expect this market price necessarily because the price may move by the time your order is executed. But the point to understand, at least it's a market lock transaction. So that's what it is. Yeah.
So it's like on the spot.
What is on the spot?
Like you might not know what price you will get for your 20%.
Yeah, so that, as we'll discuss when we discuss market orders, we'll go into that discussion. But you only know that if you're placing a limit order or a stop limit order. Okay, those are, when we come into order types, you'll understand. But in general, market order, you have to understand that in the case of a market order, you cannot expect to get the market price that you're seeing. The market price that you're looking at the time that you transmit the order is not something that you're guaranteed to receive.
Yes.
In the case of a market order, if you want to guarantee the price, then you would place a limit order. We will look at that when we look at order types. When we look at order types.
So, if I look at this case, how will I confirm that this trading is happening? For example, I'm looking at Amazon, so it's US dollar.
So that the way you know that is, remember when you enter the ticker, suppose you think of a new company which is not listed there, GE, General Electric. When you enter GE, it gives you a whole bunch of options, right? You can see that it's listed on the NYSE, okay? And there are many platforms, but at the moment we go for smart, okay? Smart essentially means smart routing that Interactive Brokers is itself going to do. But actually in the US, although you're trading on the stock is listed on the NYSE, but there are many venues for trading the stock. Like you have all kinds of ECNs and other markets within the US. It will basically for the same. This is the short answer to your question. That the moment you enter GE, first you have to know that the ticker for GE is GE. Like if you're looking at Alibaba, you have to know you can't write Ali. Of course, if you write Ali, they may still help you with an autocomplete and all that. But you should know that the ticker for Alibaba is Baba. Okay, and so therefore, the moment you enter Baba, it will give you an option. Do you want to trade? This is the NYSE. You've seen there are many other options for GE. So you don't want to trade like Georgia government bonds. You're not interested in Georgia government bonds. You're interested in General Electric stock, which is trading on the NYSE, and you're choosing smart routing. So that's how you know that stock means spot equities. Here stock means spot equities. You can see futures and options are also other options, other alternatives given to you. But this is how you know that this GE is a NYSE listed stock, and this is the US market. Does that answer your question?
Yes, sir, I get.
Because questions never end. It's like rapid fire. The moment you answer one question, the next question comes. Okay, go ahead. No, I'm not trying to embarrass you. Go ahead. That's a good thing actually, that you have so many questions.
The NYSE, so from reading NYSE, I don't get to know we are talking about shares. So when we use commodity market,
No, not necessarily. The NYSE may list bonds also. Okay. They call it the New York Stock Exchange, but they may list corporate bonds also. It's not necessary that they will only have stocks. But whenever you're entering a ticker and asking for a price, that's when you basically get to know that this is the instrument that they're talking about, right? Is this clear? Yeah. What was any other question? Yeah. What is your question? Okay, 1 minute. Yeah.
When you're quoting the price of sugar, so I wanted to ask that you were selecting September, or is it that quarter-wise divided?
No, it depends on it depends on market. It varies from market to market. There are certain types of contracts, like the financial contracts, like S&P 500 futures, US Treasury note futures, where they are fixed into very set quarters. Like they will be March, June, September, December. Okay, in the financial contracts. Okay, but in the agricultural commodity contracts, you can't be sure about that kind of regularity. It depends on the harvesting seasons. Okay, planting season, those kinds of. So it really, in the case of agricultural contracts, you'll see that if you look at, say, crude oil futures or any other commodity contracts versus wheat versus sugar, cotton, you will see that there could be variation in the contract months, and those are all basically related to the selling cycle, the harvesting cycle. It is related to the dynamics of that particular commodity market. Okay, so essentially you'll have to go market by market. If you're interested in trading wheat, you have to understand the dynamics of the wheat market. You have to know the specific months for which wheat futures are traded, and they may not be the same as the months for cotton futures. So that is market to market. Basically, it's driven by the dynamics of that market.